This is Nightly Business Report with Sue Herrera and Bill Griffin.
Return to sender. FedEx says the global economy is getting weaker and its profit and revenue are hurting.
Great rate expectations. Federal Reserve officials begin a two-day meeting on interest rates, and the mixed messages on the economy are creating a lot of confusion.
Help wanted. Amazon is attracting job seekers from across the country as it hosts the nation's largest career fair. Those stories and much more tonight on Nightly Business Report for Tuesday, September 17th.
Good evening, everyone, and welcome. FedEx is considered a barometer for the global economy. The company moves so much freight that it's able to give a clear view of economic and business activity. But tonight, that view is cloudy. The delivery company reported a double-digit drop in profit, weaker than expected earnings and revenue, and it issued a soft outlook. It's blaming an increase in uncertainty due to trade tensions and the further weakening of economic conditions around the world. And that sent the stock sharply lower in initial after-hours trading. Frank Holland has more on FedEx's quarter.
FedEx reported profits lower than expected and says it expects profits for the next year to be lower as well. CEO Fred Smith citing the ongoing trade war as a primary factor. Smith saying FedEx is, quote, negatively impacted by a weakening global macro environment driven by increasing trade tensions and policy uncertainty. The biggest takeaway is the uncertainty of the trade war, to use Smith's own words, continues to hurt the growth of the U.S. economy, even for a business like FedEx that is actively pivoting to increase its focus on its domestic business by starting 7-day-a-week delivery in January. For Nightly Business Report, I'm Frank Holland.
Let's turn to Donald Broughton now for more on FedEx, the whole transportation sector, and what these numbers tell us about the health of the global economy. He is managing partner at Broughton Capital. Good to see you again. Welcome back.
Thank you. Good to be here.
I've already seen one analyst note tonight who's downgraded FedEx stock. He says, yes, global tensions and the trade war are a problem, but some of these problems that FedEx is experiencing are self-inflicted as well. What do you think?
Well, I think the time to close the barn doors before the horse gets out. Last week, we put out a report on Asia-Pacific air freight, signaling that it was down strong double digits and continuing to decelerate at increasingly alarming paces. Bottom line here is that FedEx has gone from, in just 90 days, from predicting moderate U.S. economic growth, from growth to moderate growth. They've gone from predicting, despite cost cuts and increasing the amount of those cost cuts from mid-single-digit declines in earnings for the year to 16 to 30% decline in earnings. This is not an alarmist company. It's a conservative company, well-run, global impact, and the bottom line is they are increasingly concerned because tariffs are terrible taxes, bottom line.
Now, FedEx obviously has a much more global footprint than some other companies in the transportation area. But do you anticipate that, given what FedEx laid out today, that we are going to hear more of this type of reporting from some of the other key transportation stocks and companies?
I do. And the reason we do is very simple. This is 1% of the weight of the economy, but it's over 15% of the value of the tangible goods economy. It drives tech. It drives hiring engineers. It drives investment. They move high-value, low-density goods. They move that in the information age, in the technology era we live in, they move the driving force of the economy, both globally as well as specifically the U.S.
So do you worry about this sector? Do the decline in some of these stocks present opportunities yet, or what are you going to do with them now?
Well, on a case-by-case basis, there is definitely opportunities to look at best-in-class performers. But the bottom line is you have to have a view longer than a few weeks or a quarter or two, because in the short term, you're seeing continued dramatic declines in volumes. And even the best-in-class companies are going to struggle to produce improvements in earnings in that environment. And there's no catalyst to seem to stop those rates of decline as long as we have these tariffs in place.
Donald Broughton from Broughton Capital, again, thanks for joining us tonight. Appreciate it.
Always a pleasure.
Global economic risks, like the ones that FedEx outlined, are among the issues that Federal Reserve policymakers are discussing. The The central bank's two-day meeting began today with a decision on interest rates scheduled for tomorrow. Steve Leisman takes a look at what's expected.
Wall Street expects the Federal Reserve to cut interest rates tomorrow amid growing concern about economic weakness, recession fears, and the trade war. 100% of respondents to the CNBC Fed survey see the Fed cutting rates by a quarter point after it announces results of its September meeting. Nearly all expect another quarter point cut by year end. The problem is that forecasts for lower rates come with a reduced outlook for U.S. growth and an increased probability of recession. The chance of a recession in the next 12 months soared to an 11-year high of 32%, according to the survey. It was below 20% for most of last year. Growth is forecasted to decline as well to 2.2% this year from 2.5% in 2018, and it sinks to just 1.8% in 2020. Economist Joel Naroff writes in response to the survey, quote, "A trade war that continues into next spring or summer almost certainly causes a recession that's likely to spread worldwide." Now, not everyone agrees. Richard Sichel, senior investment strategist at the Philadelphia Trust Company, says recession talk has been overdone. Yes, there has been some slowdown in various economic indicators, but the outlook for robust holiday spending is good based on the high level of consumer confidence. That should drive growth and stocks higher. For now, respondents to the survey see very slight gains ahead for stocks, but continued low interest rates. The question is whether Fed rate cuts will be enough to offset the negatives from the trade war and global economic weakness. The high levels of the stock market amid those continued forecasts for ever lower rates suggest the market's betting the Fed is going to win that fight. For Nightly Business Report, I'm Steve Leisman.
The manufacturing portion of the economy rebounded unexpectedly in August. It was up 0.6%, with the biggest gains in oil and gas production. Manufacturing has essentially been in recession this year, one reason the Fed is likely to cut interest rates again tomorrow.
But confidence among the nation's home builders hit its highest level of the year. Sentiment was helped by a drop in mortgage rates, but according to the new survey, builders are growing concerned about uncertainty stemming from the trade dispute with China.
Don't look now, but there are now fewer than 100 days until Christmas. 99 to be exact. It's the most important time of the year, obviously, for retailers, since consumer spending makes up roughly 2/3 of all economic activity, and the bulk of that occurs during the holiday shopping season. And according to a new survey, Americans this year are ready for a healthy dose of retail therapy. Courtney Reagan has details.
With less than 100 days to go until Christmas, two consultant groups are out with upbeat holiday sales forecasts. Deloitte says holiday sales will grow as much as 5% above last year, topping $1.1 trillion. Alex Partners forecast holiday sales will increase a little bit more than that. Both forecasts are well above last year's holiday sales growth.
We were up against some really interesting comps. We were in the midst of a government shutdown in December. We also had a really tough time in the market. And so we have a lower base to compare to. So that's one reason why the forecast is higher. Second, unemployment and job growth continues to be really good, and that really bodes well for the consumer.
This year, Alex Partners warns that while its forecast calls for a strong season, it acknowledges what it calls, quote, unprecedented uncertainty. So it's advising retail clients to, quote, be ready for virtually anything, both this holiday season and into 2020.
What we can't factor in is uncertainty. And so our advice to our clients is really related to focusing on the elements of uncertainty that are likely to drive consumer behavior one direction or the other, and then be prepared to have a plan to address those if and when they come up. So hope for the best, prepare for the worst.
Deloitte, too, acknowledges there are risks to its joyful forecast.
Anything that really takes money out of the consumer's pocket in the fourth quarter is an issue. So if we find spikes in gasoline prices or other things that really take away from consumer confidence, that has a tendency to put risk in the forecast itself. The fundamentals of the economy are still really strong. Our hope is that we don't talk ourselves into a downturn here in the fourth quarter.
Despite concerns about the impact tariffs are having on the economy, neither retail consultant group has seen it show up in prices consumers pay in a significant way yet, and neither expects a big impact during the holiday season. For Nightly Business Report, I'm Courtney Reagan.
And joining us now to talk more about the state of the economy is Mark Vittner. He is a senior economist at Wells Fargo Securities. Welcome, Mark. Nice to have you here.
Good to be back with you.
So we heard some pretty downbeat news from FedEx a bit earlier. in our program. But on the other hand, confidence among some key components of the economy, namely builders, is high. So as we go into this holiday season, what are you expecting?
Well, the further you get away from the global economy, the better things look. And the U.S. is largely a domestic economy. And so we're holding up very well among all these trade winds that are blowing out of the trade war. We're looking for pretty good sales this holiday season. We are going to be up against some weak comps from a year ago because the reported retail sales really plunged in December of last year when we had that 1,000-point sell-off in the stock market.
Yes, but the calendar is working against retailers this year. Thanksgiving is late this year. And I guess you think that means we're going to see more discounting in the month of December. Is that the idea?
Yeah, Thanksgiving comes about as late as it can. It comes on the 28th, and that means that Cyber Monday will occur in December. So the bulk of online retail sales will show up in December. That should give us a real strong sales this year relative to last year. But a lot of consumers like to go out to the stores and look at the merchandise and then come back and buy it online. With the compressed timing between Thanksgiving and Christmas this year, I think it's going to be a good year for brick and mortar retailers too.
Mark, what does this do for the Fed in its decision tomorrow, given what FedEx said? There is a global slowdown and it does affect the U.S. What are your expectations?
Well, the volume of international trade has fallen over the last year, and that's something that you really don't see outside of a recession. So I think the Fed has to cut rates. They have to give the economy as much downside protection as possible. We think they're probably going to cut rates again in October, and then probably take a step back and look and see how things are holding up. But we've got another rate cut in the first quarter of next year as well. Very
quickly, Mark, before you go, it occurs to me that with the trade war and the tariffs, that many retailers bulked up on inventory early on this year. Did they overdo it? Is there a possibility of that, do you think?
There's a possibility of that, but I think sales are going to be up 5% year to year. There hasn't been a lot of goods inflation, so I don't think the tariffs are going to be much of an issue this year. Certainly, if the trade war intensifies, that's going to be a problem for 2020. But I really don't think the trade war is going to show up at retailers this year.
On that note, Mark Vittner at Wells Fargo Securities. Thanks, Mark.
Great to be with you.
And to the market now on Wall Street. Stocks were a little changed today ahead of that Fed meeting announcement tomorrow, and retail stocks fell. Bank stocks did. Energy stocks were down. They were lower on the retreat in price of oil, which we will get to in just a moment here. But first, the closing numbers for this day, with the industrial average rising 33 points. We're at 27,110. NASDAQ was up 32. The S&P gained 7 points today.
Time to take a look at some of today's upgrades and downgrades. Home Depot downgraded to neutral from buy at Guggenheim. The analyst says its business investment will prevent margin expansion. The firm removed its $230 price target. Shares fell a fraction to close right about at that level, $230.21. Snap was upgraded to neutral from negative at Susquehanna. The analyst sees further advertising growth into the fourth quarter. The price target is $18. The stock rose more than 6.5% to $16.83. Coverage of Match Group was initiated with a buy rating at Citi. The analyst says the parent company of Match.com and Tinder could grow internationally. The price target is $95. The shares gained 4% to $79.71.
Still ahead, the maker of OxyContin has its day in court. The maker of Juul e-cigarettes says its sales have been halted in China just days after they were introduced there. Juul vaporizers have been available for purchase online through Alibaba and JD.com. The company gave no reason for the sales halt. Juul says it remains committed, though, to providing adult smokers in China with an alternative to cigarettes. China is currently the world's biggest tobacco market with over 300 million smokers.
Oil prices fell sharply today after yesterday's historic rally. The price of domestic crude settled more than 5% lower after the Saudi energy minister said the kingdom's oil supply will soon be back online. Not surprisingly, the unprecedented attacks on the Saudis' oil industry has been the talk of a major energy conference this week in Houston. And that is where Brian Sullivan is for us tonight.
The last 48 hours in the oil and gas market have been some of the most volatile and wild the world has ever seen. After word of a massive attack on a Saudi facility on Saturday shocked the world, oil spiking higher on Monday, rising around the world by nearly 20%. But the Saudis working hard to try to calm concerns, saying they plan to be back online in a couple of weeks and be fully back to production in October. Earlier on Tuesday, the Saudi energy minister, newly appointed and one of the sons of the king, came out and touted his country's ability to get back to normal so quickly.
Where would you find a company in the whole world that went through this devastating attack and came out like a phoenix from the ashes? None but Saudi Aramco.
But here at the Gas Tech Conference in Houston, Texas, one of the biggest natural gas conferences in the world, the reaction was fairly mixed. Everybody was talking about it, some suggesting that perhaps the markets overreacted with their big gains on Monday. But the head of one of the world's leading consulting and research firms in oil and gas says that's not the case.
I don't think they overacted at all. So yes, the price went up 20% and it has now come back a little bit. But this attack has come at a time where supply, spare capacity is actually very limited. So it's taken out 5.7 million barrels per day, and that's on top of around another 5 million barrels per day that was already off the market for various reasons.
The question now, of course, becomes what does this do to the global energy markets? Does it add on that so-called risk premium to prices? Well, the head of a Norwegian liquefied natural gas company told us that while this was a very serious incident, his belief is that it was more Saudi-specific than a true global problem.
I would like to think of that as something that is very unusual. So obviously, there are reasons behind that which I don't think you will find other places in the world.
The problem, of course, in this interconnected world, more than 100 countries are represented here at this conference, is that oil and gas prices, they are linked together globally. But the one thing that many U.S. company CEOs hope, and the fact that their stocks have been beaten down so much over the last couple of years, is that this gives renewed attention on the U.S. oil and gas industry. And the CEO of a company making a multi-billion-dollar bet on U.S. natural gas, Chalurian, told us that she thinks this will highlight the American energy revolution.
It really highlights the importance that the U.S. can bring in terms of offering the strategic petroleum reserve, but even other supplies and production as we become one of the largest exporters in the world for not only oil, but for natural gas.
But whatever happens long term, everybody here agrees on one thing. The pace of the last 48 hours simply cannot be sustained, and the world will wait and watch for what may be next. For Nightly Business Report from Houston, Texas, Brian Sullivan.
A big investor in Kraft Heinz trims its stake. That's where we begin tonight's market focus with the food company's second largest shareholder, 3G Capital, selling 25 million shares, but it still does own roughly 20% of all outstanding shares. It's been a tough year for Kraft Heinz. It took a big charge and sharply cut its dividend back in February after receiving a subpoena from the SEC over accounting issues. Shares today dropped more than 4% to $28.36, only just a few dollars off its all-time low. Investors got their first chance to respond to Corning's earnings warning issued late last night. The specialty glass maker lowered its sales and volume expectations for materials found in TV sets and some communication cables because of weak demand. And the stock fell about 6% today to $28.23. And Sony is rejecting a call by activist hedge fund Third Point to spin off its chip business. Sony calls that unit a critical growth driver for the company. Third Point has also urged Sony to sell off stakes in Sony Financial, Spotify, and other non-core assets. Sony shares fell a fraction today to $59.94.
SeaWorld CEO will be leaving his post just 7 months after taking the job, saying it was because of a, quote, disagreement over the board's involvement in the decision-making at the company, end quote. SeaWorld's chief financial officer will now serve as the interim CEO. Shares were down more than 5% to $28.52. Viacom CEO, who will be the head of the newly combined Viacom and CBS, says the merger will officially close in December. But he also says he expected a better reaction from investors, especially with what his new company can bring to consumers in content.
A library of 145,000 television series, 3,600 films, participation in news and sports, and obviously entertainment, scripted, unscripted, on a global basis. It's a tremendous opportunity, and it really positions us to be a preeminent content provider to the world.
Viacom shares dropped more than 1.5% to $25.75. And after the bell, Adobe reported better than expected results, but the software maker gave a weak forecast because it sees growth slowing in its digital media business. Shares were volatile in after-hours trading, but they closed the regular session up a fraction to $284.69.
Bankruptcy proceedings for Purdue Pharma are underway. As we told you yesterday, the maker of OxyContin reached an agreement in principle to resolve the majority of the thousands of lawsuits against it that claim that it helped fuel the opioid epidemic. Meg Terrell is at the courthouse in White Plains, New York for us tonight.
In a roughly 3-hour-long bankruptcy proceeding here today, attorneys for Purdue Pharma asked the judge essentially to allow the company to keep its lights on and to continue paying employees and suppliers as the beleaguered maker of OxyContin moves through bankruptcy proceedings. It was a somewhat muted prelude to what could be a bitter fight.
Purdue has been sued by more than 2,600 entities, claiming it fueled the opioid crisis that's taken 400,000 lives in the U.S. in the last 2 decades. Its bankruptcy aims to settle those cases, giving the company and its assets over to plaintiffs. A sticking point, though, involves Purdue's billionaire owners, the Sackler family, better known for its donations to museums and universities. The families agreed to pay $3 billion over 7 years as part of the resolution, and possibly more pending sale of its overseas pharmaceutical companies. But at least 10 state attorneys general say that's not enough, and some have named the Sacklers themselves in their suits. In a brief filed before today's hearing, Purdue's attorneys said they plan to ask the court to stay litigation against not just the company, but also current and former owners, officers, directors, and employees. That could act to shield the Sackler family. Meanwhile, Purdue's attorneys say AGs and authorities from 24 states and 5 territories, as well as representatives of thousands of cities and counties, have signed on to the deal. One of those representatives is Motley Rice attorney Joe Rice.
And that's what the litigation is all about, is to try to get some financial help from the industry to help these communities and these states deal with this problem.
Purdue's attorneys say they're hopeful more plaintiffs will sign on. For now, the fight continues for Purdue and the Sacklers, and separately dozens of other drug companies, distributors, and pharmacies named in the litigation. Rice, who was involved in the tobacco litigation that led to a $250 billion settlement in 1998, says this case is much more complicated because of how many defendants there are.
With tobacco, we just had the major tobacco companies to deal with, and they owned it from manufacture to delivery.
And he notes it'll take an enormous amount to address the nation's opioid crisis. For Nightly Business Report, I'm Meg Terrell in White Plains, New York.
Coming up, Amazon hangs out the Help Wanted sign. Another medical school is offering free tuition. Weill Cornell Medicine in New York said all students who qualify for financial aid will get a full ride, covering everything from tuition, room and board, books, and other expenses. While doctors can be among the highest earning individuals, they also carry a heavy debt load, totaling on average $200,000 out of medical school.
Finally tonight, Amazon is looking for workers, a lot of them. So it put together the largest nationwide job fair to fill thousands of positions. Deirdre Bosa is in Arlington, Virginia for us tonight.
Amazon isn't really in the business of doing anything small. So today, as it holds a career day in 6 cities across the country, it's not looking to hire just a few people. It's looking to fill 30,000 roles.
I'm in retirement currently, and it would take Amazon to bring me out of retirement.
Brick and mortar stores are going out of business. Like, Amazon is the future.
I'm looking for a warehouse. I have a lot of warehouse experience, driving forklifts,
as well as logistics, so something along that line.
Candidates here in Arlington, Virginia are also looking for positions beyond the warehouse in marketing, information technology, management, and more as Amazon has moved beyond its core e-commerce business and into new areas like advertising, groceries, and video streaming.
At Career Day pop-up tents across the country, like this one, where job seekers lined up hours before it opened and in fact are still streaming in, Amazon is giving out information and acting as career coach.
Relate those leadership principles to the answer that you're providing to us.
But while 30,000 jobs is a large number, it represents less than 1/20th of Amazon's total global workforce, and one that has seen its growth decelerate significantly over the last few years. At the start of 2018, Amazon's workforce grew 60% year over year. At the start of this year, just 12%. Certainly, the law of large numbers plays a part, but it also reflects slowing growth in Amazon's core business, e-commerce. And then there's the quality of jobs. Scrutiny of Amazon has risen in the nation's capital over the last few years. Democratic candidate Bernie Sanders has demanded better working conditions for Amazon warehouse employees, while some of those workers have gone on strike during peak shopping times. But for many job seekers, the prospect of a job at Amazon is worth waiting in line for. For Nightly Business Report, Deirdre Boza, Arlington, Virginia.
Here's a final look at the day on Wall Street. The Dow rose 33 points to 27,110. NASDAQ was up 32. S&P 500 gained 7. That is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.